And thank you for having me. So really there are two elements to this. We've seen a number of profit warnings across the industry in recent weeks, largely due to the slowdown that we're seeing in terms of consumption for Western vehicles in China, with China having been an important part of the earnings contribution for the German manufacturers in recent years. And then, as you point out, the second challenge is really the slowdown in EV sales. In Europe, battery electric vehicle sales are down over 8% year to date to a penetration rate of 12.6%. And we believe the principal driver of this is economics. When we do the analysis, buying a battery electric vehicle and owning and running it for 4 years is no longer that attractive compared to an internal combustion engine vehicle in many markets.
So, but in other words, that means we need subsidies in order to revive and keep the industry going, or is that the case?
I think if we look back at when there were subsidies to help consumers with the purchase of battery electric vehicles, certainly the economic equation made more sense. However, obviously, subsidies, whether they are affordable in perpetuity, is a larger question. And I think that when we look at the EV transition, we need more support across the board in terms of charging infrastructure, in terms of consumer education. And then also from the manufacturer's side, obviously there is a lot of work to bring down the cost of the vehicle through developments in battery chemistry and other technologies.
Yeah, that brings me directly to Volkswagen, the biggest car maker in the world. Some do say it's Toyota, but they're really gigantic and now do battle the cost structure. So what do you think? How much cost do they need to take out to actually stay competitive or become competitive?
Yes, so late last year, Volkswagen announced a €10 billion cost-saving program for the Volkswagen brand. And in recent weeks, we've seen press reports suggesting that they need to increase this by a further €5 billion. This is all to try and get to a 6.5% margin at the Volkswagen brand by 2026, which we would view as competitive in the context of the broader industry. However, when we look at Volkswagen, it faces the same challenges as the other German manufacturers. The profit pools in China are diminishing due to increased competition at the low end and a slightly softer consumer at the top end. In addition, the transition to the battery electric vehicle, the software-defined vehicle, this requires different skill sets. Those skill sets aren't necessarily located in the same locations. It also comes with a very big investment burden.
Yes, but at the same time, if you look at, for example, the Volkswagen electric vehicles, the pricing is a problem as well, potentially, if you compare to, say, Korean competitors. So do they drastically need to reduce the prices as well to be competitive in that market?
Well, I think when we look at the European car companies and Volkswagen specifically, they're trying to sell battery electric vehicles at a profit. They realize that battery electric vehicles are a bigger part of their future. So at this point in time, it doesn't make sense to sell them at a loss. You need to try to maximize the profit so that your profits in the future can match the profits in the past. When we look at the competitive dynamic, one thing which the European manufacturers have been slightly slow to transition to is LFP battery chemistry. LFP is a cheaper technology. It's very prevalent in China. It's fairly ubiquitous amongst the Chinese domestic manufacturers. And this is something which the German manufacturers will start to transition to over the next couple of years and can help to dramatically reduce the costs of their battery electric vehicles.
Yeah, but if I